The global trade war shows no signs of easing. President Trump has threatened to slap a 200% tariff on wine, cognac and other alcohol imports from Europe. US indices fell as a result, with the S&P 500 ending Thursday more than 10% below its record high reached last month. That confirmed the index was in correction. Well, Janet Moy is head of market analysis at RBC Brewin Dolphin. Janet, the president's latest threat came after the EU said it was looking to impose tariffs on American whiskey and other products, and that in itself was in reaction to Trump's 25% levies on steel and aluminium, which kicked in this week. Can you see a solution between the US and Europe, or will this trade dispute just run and run?
I think, unfortunately, in the near term, there is likely to be more escalation, judging from EU's retaliation, which is normal, given that when you're threatened with tariffs and applied with tariffs, then I think the normal course of action is to retaliate and hope for negotiation. There's certainly room for negotiation, I think, but Trump's reaction of threatening to slap 200% tariff on a range of products from EU is unhelpful, and it just shows that there's this risk of spiraling of these tit-for-tat tariff. So I do think, yeah, unfortunately, I think given both sides' reaction, we can just kind of assume there would be more escalation in the future. Particularly, there is still going to be reciprocal tariffs coming from the April the 2nd, which there's still a lot of uncertainty on the extent and the coverage and the duration.
Now, also, talks between the US and Canada failed to reach a breakthrough. Surely this is just bad news for consumers everywhere. And the market reaction suggests that investors think there could be a big hit to economic growth in the world's largest economy. Do you think that they are right?
I think so. I think markets have been too complacent for a while. I mean, fair enough, given that tariffs are always viewed as negotiation tactics of Trump. But unfortunately, the recent developments suggest to us that he means business, and he the negotiations could take place, but it would be very difficult anyway. And so I guess, yeah, tit for tat is very likely going forward. So that means, if the US were to apply tariffs to all of these nations, including the upcoming reciprocal tariffs, then I think it's very likely that companies are going to pass on these higher import costs to consumers. There are lots of studies from the Federal Reserve on the first trade war on that. So companies are very likely to pass on costs. So eventually, consumers are the people who are going to suffer from these high prices, unfortunately. And of course, that is going to hit growth. But of course, the problem is that we still don't know if further tariffs are coming, right? So I think that's really the key to watch.
Well, one side effect of all of this is that investors are looking at safe havens a little bit more closely now, and gold has gone through the $3,000 an ounce mark today. It wasn't that long ago that analysts at Goldman Sachs were talking about 3,100 by the end of this year. Do you think they're going to have to revise their forecasts once again?
Well, it's quite often that analysts have to just quickly revise their forecast, and could be happening for gold as well, because so far for this year, right, we see that the safe haven trade is really a government bond and gold. But I think the government bond aspect still has certain risks, because ultimately investors would worry about the US deficit and debt. So that there's still some element of worry there if inflation picks up, if all these tariffs are going through. But gold is really regarded as a hedge, as stagflation. It works well in an inflationary environment, low growth environment, and also, of course, these geopolitical tensions that is happening at the moment. So I do think investors probably would favor gold going forward, given this uncertain outlook.
Now, the UK seems to have sidestepped tariff threats for now anyway, but there was bad news for its economy today. It unexpectedly shrank by 0.1% in January. I know monthly data can be volatile, but what's stifling growth in the UK right now?
Yes, I mean, the small contraction we have seen is mainly due to construction and manufacturing. I mean, construction activity has been weak for a while. I mean, the sector has been weighed by still relatively high interest rates. And I think manufacturing activity, we saw that the manufacturing PMIs across the world has been pretty much stagnating or in contraction. So no big surprise, but I think there could be some elements of worry on the trade tariff fronts globally. Uncertainty, is a highly cyclical area. So yeah, mainly due to manufacturing and construction. I mean, services held up okay, but only really small gains. So overall, if you average out December, January, you barely get any growth anyway. And in fact, we have been barely getting any growth since Labor took office. And, we're still not talking about the real national insurance taxes coming through from April onwards. So I think that's pretty concerning for the UK economic outlook.
That was Janet Moy from RBC Brewin Dolphin. And don't forget, you can watch more videos on Reuters.com.